Hello, listeners, and welcome to another episode of Alternative Disruptors. Life science real estate has often been talked about as one of the most resilient sectors of the property market in the US. But today we're faced with a sector in transition. After a wave of supply and a slowdown in tenant demand, vacancies have risen sharply in some of the biggest US clusters. At the same time, long-term drivers like talent, funding, onshoring, and biomanufacturing still point to major opportunity. So, where is the asset class headed, and how should investors separate hype from durable value? To answer these questions and more, I spoke with Joe Fetterman, who is Executive Vice President at Colliers and provides strategic solutions to the firm's life science and healthcare clients. Joe's background in architecture, real estate development, and financial analysis, along with his more than 4 decades of experience, position him as a top-tier expert when it comes to the life science sector. I hope you enjoy our discussion as we take a broad look at current dynamics shaping this asset class. Hi, Joe. Welcome to the show.
Hi, Tudor. Thanks for having me.
So, yeah, I wanted to start off here by getting like sort of a broad view of things, as life science real estate is just one of the most compelling alternative asset types still, but we're now in the sort of the tail end of the construction and absorption boom that we saw during and post COVID. So how are you seeing these fundamentals? How are things looking from your perspective?
Well, I tell you what, if I'm sitting in the developer's chair, it's still a very challenging time. The enthusiasm that was generated in 2019 and 2020, both in terms of the discovery that was happening and also the follow-on enthusiasm from investors, VCs, and private equity in the life sciences sector was very robust. As you know, buildings don't get put up in a day, so the fundamental challenge in real estate is that you see massive demand for space. You go to meet that demand, and then, of course, the dynamics of real estate are such that markets change. And a couple of things happened. We came out of COVID. We went through an incremental interest rate increase period, and we saw also that some of the results with some of the companies were not quite as favorable as were initially anticipated. And so enthusiasm for the sector somewhat diminished as well, particularly for early stage. There was a point in time where I don't care what you were doing, if it sounded good, the money was coming. Those days are gone. And then, we had a lot of enthusiastic developers, and it makes sense that we would have. And so there's a lot of product. I think the challenges are largest in the primary markets, those being Boston, San Francisco, San Diego. Yet that said, those are also the markets that can recover very quickly with very large requirements. But the surplus that we have today is going to take some time to be absorbed.
Yeah, I noticed from your 2026 outlook that both, I think, 24 and 25 still had a very, very large share of new construction come online, but it hasn't been absorbed.
Yeah, the absorption has been slow. I will say at the beginning of both 24 and 25, I was extremely enthusiastic in January about the year that came ahead. And in 24, we had one good month, and then it was 23 deja vu all over again. And 25, I was a little less enthusiastic about the transition from December into January. And it too resembled the same. So I had no enthusiasm going into this year. And I'm pleased to say that there are some very lively activity areas in the life sciences. So it's kind of fun. I'm glad I wasn't hopeful for the new year, but I've been very pleasantly pleased with how we transitioned into 26.
According to the report, like there are some signs that there is some stability to look forward to, right? And but do you think like that's a full swing recovery, or is we're just getting there?
Tudor, it's really interesting. I mean, we've always known that there are two fundamental areas of the life sciences. I mean, there are multiple areas of life sciences, but if you think about it, there's the R&D lab segment, and then there's the biomanufacturing or manufacturing at large. And so the area where the life sciences market has suffered the most has really been in the R&D lab segment. That has to do with company formation, investment in companies, lessons learned about how to manage capital. All of those things have put a damper on demand for new R&D lab space. Interestingly enough, on the biomanufacturing side, though, we see a handful of things that have been in the works ever since COVID. I mean, there was a lot of talk during COVID and shortly after about onshore. And there was an anticipation that there was going to be a significant amount of onshoring of both CDMO function and biomanufacturing by pharma companies. And while there was some, it was not as robust as anticipated. What we're seeing now is that momentum has picked up considerably. And I think there are a handful of factors that are contributing to that. The first of which is that it was slow in coming, right? So it's finally all the efforts that were initially put in place to bring companies to the U.S. are now starting to happen. Number two, there was an extremely strong tailwind created by the whole tariff dynamic. Once companies started to see that dynamic happening, I think that if it was necessary to push a company over the edge, that may have done the trick.
Yeah.
Number
not
three,
just in life science. Sorry to interrupt.
Yeah, not just in life science. No, absolutely. That dynamic has occurred all over. Number three, we're the largest consumption market of pharmaceuticals, and so it makes a lot of sense that companies would want to be in close proximity to a large market.
Yeah.
And so that all of that has contributed. And then, of course, there are a few blockbuster drugs that we've all heard about. They're frequently advertised on TV, and those companies need more capacity to manufacture. So that's also both from abroad and from within. There's a lot of pressure to create additional manufacturing capacity. That's been interesting. We've been busy with several European requirements that have been looking in the U.S., and we anticipate that there will be more of that. I mean, you see Lilly, J&J, Merck, GSK, all of them with announcements. I mean, it's been quite robust. All of my friends in the engineering, design, build process are very busy working on large projects.
Yeah, there have been some pretty large announcements in 2025 and this year as well, I think.
Yeah.
So when looking at life science as an investment category, like apart from manufacturing, where else is the opportunity today?
There are developers, there are investors, and there are lenders, all of whom may feel like we've got too much exposure in this category, and may be willing sellers just to balance that out. And in those cases, I think that's an opportunity for the right buyer who understands life sciences, B, understands the market within which they're investing, geographic market, the fundamentals of that market, and C, has a pretty good read on where they think they'll be able to do rents. Obviously, the initial folks in somewhat had no choice because of the cost to deliver purpose-built life sciences lab buildings in particular, but in general, those buildings are expensive to build. The infrastructure for them as a category is one of the more expensive categories to develop and build.
Yeah, and there was a lot of speculative construction on that in the life science sector in following the pandemic.
There was. I mean, I will say this: it was by the. I think they, for the most part, were experienced and smart players. I don't think they expected the dynamics of the market that we talked about earlier to shift quite as fast as they did.
Yeah.
But this is by no means the first sector in real estate that supply and demand is never a balanced situation. It's always shifting one way or the other. It's funny. I've even heard the term talked about. We heard a lot about conversions in 2020, maybe even as early as 2019, 2020 to 21. There were very few who pulled that off really successfully.
Okay.
Now we're hearing a little bit about reversions, where it's conceivable that a purpose-built life sciences building, because it's new, because it's fresh, may be an opportunity for, let's call it a headquarters use or some other primary use where, unfortunately, a little of the infrastructure will be of value to that, but not the lion's share of it.
Yeah, so it's kind of, so you're saying that it's a significant investment even to do these types of reversions.
No, I mean the opportunity. If a landlord makes the decision that they're open for business, whether it's lab or whether it's office, or for that matter, whether it's kind of a techie use, more of an innovation use, but not necessarily life sciences. I mean, the good news is that the building is well situated to accommodate a lot of those things. So, for example, the kind of clear heights that might be provided for a lab user make for really interesting space for an office user. I mean, if you've got an innovation company or a creative company that wants really special space, you've got opportunities to do things that you might not be able to do in a more traditionally built office building, where they would not have gone to the trouble of expanded clear heights. And the users, there's going to be an interesting balance to the extent that developers and owners make the decision to go to traditional office space. There's going to be, finding that equilibrium between what deal can we live with on the part of the owner developer and what deal can we strike on the part of the user that we can live with, that we won't regret for the next 10 years because we could have paid a percentage of that cost for our space. So that's an interesting dynamic, and that will find its equilibrium. And I would go so far as to say different markets are going to find different equilibrium points in that regard, depending on how extensive that surplus of space is.
Yeah, and that makes sense, because the sort of the characteristics of these markets are very different, and I want to get into that in a few moments. But first off, I wanted to ask about I wanted to circle back to something you mentioned earlier, which is you were talking about this lab space versus manufacturing dynamic, and I was wondering how do the demand drivers look for these two types of assets?
Great question. So I think they're on the let's start with the lab side. And on the lab side, I think there are 3 or 4 drivers that impact that demand. The first is discovery. And I would say that the discovery arena is as healthy as it's ever been. The kind of science that's being done in the academic institutional research environments is really first class. It's cutting edge. It's exciting, and it's resulting in company creation. The second factor is just that, company creation. How quickly is what's being done in the lab, in the institutional academic environment, how quickly is that converting and becoming a new startup company, or advancing into the commercial realm? The third factor is the investment community, and are they feeling a little bit better about life sciences? Are they willing to look more closely? And generally speaking, the dynamic is fewer investments, larger investments. So they're looking to make investments in companies where the discovery and the results are a little more proven. So rather than doing completely preclinical investment, as we were seeing in 19 and 20, you're now seeing downstream clinical investment where there's been positive results. There's some proof that this is going in the right direction, and it's a good thing. The other dynamic that's in play right now is that we're seeing a much more active and vibrant pharma investment in earlier stage companies. And that's coming in two forms. That's either coming in the more traditional licensing model, or they're actually making early investments with, if this, and this all prove out, there'll be a follow-on significant tranche of investment that comes. Now, there's an interesting side effect of that, which is that if there's a robust pharma investment model, the VCs may be a little bit more inclined to invest in companies that they think there might be, that they're positive signs with the results that they're seeing. And there may be a relatively early exit into a pharma company,
okay,
as opposed to the IPO market or otherwise. All of those things are really good fundamental trends.
Yeah.
But we're still nowhere near the roaring 19s. But I think we're moving in the right direction, and so that's what I would say about that. On the manufacturing side, I think that's going to, I think we're seeing the dynamics that we talked about earlier, and we talked about what the drivers were. I feel relatively confident that that's going to continue. And one of the areas that I'm really interested in seeing how things play out is in the CDMO space, in terms of, I think that you will see, whereas in 2019, 2020, you were seeing a number of companies looking to vertically integrate their operations and include manufacturing as part of their total package. And part of the driver for that was that resulted in a better investment model, that investors were attracted to that overall, kind of a full service growing drug company that could actually produce their own product. I feel like given the pressure on capital these days, I think a lot of companies are much, much less inclined to do that, in spite of what they may experience with the challenges working with a CDMO, whether that's timing challenges, whether that's, that they don't fully control their own destiny, whether that's even IP concerns of sharing with a CDMO. I think things have gotten better in that category. I think companies are more comfortable. And the real question in my mind is, will we see a meaningful expansion in the third-party manufacturing from CDMOs as well? So that's another factor in the mix.
So that's something to keep an eye on going
Keep
forward.
an eye on. Yeah.
Okay, that sounds very interesting. So basically, investments are more moderated, so to speak. I mean, they're more diligent, right? Investors, would you say that?
I think the leadership that the folks that are sitting in leadership positions in early, mid, and even later stage companies are A, more experienced, B, more judicious, because they know how hard it is to raise capital and how important it is to really manage the utilization of that capital. So, let's just call it a little older, a little wiser, and been there and done that, and want to do it a little bit better the next time.
Yeah, that makes sense. And do you think manufacturing could become the more durable part of life science, so to speak, through these dynamics?
It's a great question. I'll say on the one hand, I don't fully know the answer, because like anything else, too much, too fast. I've had the unfortunate experience of visiting some sites that were beautifully built, stood up, operated for a brief period of time, and are now available on a second-gen basis. It's a dynamic thing. There's no question in my mind, going back to something I said earlier, that the institutional research, the company creation, those are all going to continue to be important drivers. going to be really interesting to see how AI factors into all this.
Oh, yeah.
I promise you it will factor. There's one side of the equation that says that's going to result in a significant reduction in the demand for lab space.
Okay.
It may impact the need for lab space because there's a lot of the data and analytics that can actually be done based on work that's already been done.
Okay.
On the flip side, AI may actually generate a lot more activity. So in the long run,
Yeah.
if it's maybe a little bit less in each individual instance because AI enables you to work more efficiently, but if it opens a broader pipe of companies that are actually have things that they're working on, it's hard to predict exactly how that's going to affect the demand for lab space. I'm intrigued to watch that, and I'm broadly optimistic that will have a positive effect, not a negative effect on demand for lab space. But we'll see on that.
Yeah, cool. That will be indeed interesting to keep an eye on. And so I wanted to shift a bit here and go over, like, look at things geographically. So I wanted to ask, like, which markets right now best represent these drivers that you were speaking about earlier, and like the difference between a strong scientific ecosystem and a real estate market, like a strong real estate market.
Yeah. The strongest markets are going to be led and driven by a very strong institutional academic research facility. Some anchor or anchors in a market that are generating discovery, and that discovery is being converted. A second factor that's very meaningful is a strong VC community in and around. The third, you could argue, is existing big pharma and their ability to be investing in a cluster. And finally, I think, for many of the most the top tier clusters, if you take Boston, San Francisco, San Diego, they've had anchor companies that have been doing life sciences in that market for 20 or more years. If you will, there's a magnetic gravity around you, right? They create an ecosystem around them. So without question, Boston, San Francisco, and San Diego are the top tier. I think that quickly gets followed by Philadelphia, by Maryland. Depending on how you define it, the New York, New Jersey area is robust. And by the way, if you look at Philadelphia and New Jersey, you've got the largest accumulation of big pharma historically in the country, in a band that runs from Wilmington, Delaware, to central New Jersey, like North Brunswick, New Jersey, and a little bit beyond. I mean, there is a heavy concentration of big pharma campuses in that belt. So that also contributes. Obviously, talent is meaningful, and that talent is new PhDs that are being generated. But it's also, if you've got big pharma that's been around and you've got experienced hands that can do manufacturing, that can do, that can support the R&D, can provide jobs to the R&D ecosystem and to the new PhDs that are being generated, that's all very meaningful. So, I mean, those are the kind of what I've spoken about are the more established markets. You could throw Seattle into that mix. Denver has momentum. Houston has some momentum. Again, you're talking about an academic medical center that's driving there as well. In some cases, it's surprising that it's not more mature than it is, but one could argue that's good. There's a lot of runway for the future. So
there's a lot of room to grow.
Yeah.
Well, that's interesting because at the same time, Boston, San Diego, and the Bay Area have some of the highest vacancy in terms of life science. And is that putting a brake on things, or is that not a big deterrent, so to speak?
Well, I think a couple things. As we think about real estate in general, it's usually the most robust markets that end up with excess supply in an oversupply market. So partly, this a little bit of this is real estate 101.
Yeah,
it happens to apply to a very specialized sector of real estate. The other thing I'll say is that it's very difficult in a large market to be undersupplied. That puts a real challenge, and part of the oversupply is really the result of what 2019 and 2020 looked like in most of the markets, most of the meaningful markets in the U.S. There was no purpose-built lab space to be found, so there was second gen that put a lot of pressure on the desire to do conversions, as you alluded to before. Everybody and their cousin raised their hand coming out of COVID when there was no office market, and life sciences was the darling, and there was no lab space to be found. Everybody wanted to be a conversion. The truth of the matter is it was a small percentage of those, mostly those that invested and that had the right bones and infrastructure to really be successful in the first place. So back to your question, we've got more. We are oversupplied, and there's going to be some casualty in markets. There's going to be some casualty for owners, investors, lenders that basically have too much exposure. There's no question about that. But at the same time, it is going to be those larger markets that are going to recover more quickly.
That's true.
Philadelphia sits with an oversupply of, say, 1.5 million plus square feet, Boston with 20. But the kind of deals that Boston is going to see relative to that 20 million square feet of oversupply and the deals that Philadelphia is going to see, there's a little bit of, there's the right sizing to it. I would almost go so far as to say that the Philadelphia market, while definitely oversupplied, I think that gets absorbed fairly quickly. I think Boston will take a little longer. At one point, our researcher, Jeff Myers, did an analysis based on the best 3 over the past 5 years of absorption and applied that to the inventory that was available and did this market's going to be 1.5 years to absorb what it has, and this one's going to be 8 years to absorb. And and then we play the movie, and we'll see how it all goes.
Yeah, that's a lot to think about. So you were talking earlier about pharma and manufacturing. Do you think markets such as New Jersey and Philadelphia are becoming more attractive as opposed to classic venture-backed clusters like legacy pharma markets, such as that? Or is that a fair comparison?
There are a host of factors. I mean, it's a complicated proposition. Having worked on some of these, there are factors at play. I mean, we didn't talk about Raleigh-Durham, which is a really interesting market. And probably should have mentioned it earlier, but the Raleigh-Durham market is interesting because it is a very attractive manufacturing market. They have some meaningful supply and some meaningful ready-to-go product there. What we haven't really talked about in the decisions that companies make as to where they're going to locate, to the extent that in the biomanufacturing space, cost is a really big factor, right? If my annual cost, if I can do it in location A at 70% of the cost, I can do it in location B, that's going to factor very heavily into my decision making. Other criteria that will factor is, do I have the talent that can support the work that I want to do? And where am I located in terms of actually getting my product to my consumers? Does that need to factor? Am I a really time sensitive product because I have a very particular shelf life, whether that's temperature driven, whether that's isotope half-life driven. I mean, there are a variety of factors as it relates to location that can be there. So, there are definitely established markets. And then, there's one other factor we haven't talked about and that's the state programs to attract these companies to their geography. And that's a meaningful factor too. If there are tax breaks that they can get, if there are programs that can support the labor that they need, all of those things also factor into the mix in terms of the decisions that companies are making in terms of where they want to locate.
That's a really neat breakdown of things, and you sort of anticipated one of my other questions that I wanted to ask related to that. Before we get into that, I was thinking, because the report also mentions emerging markets, right? Like Houston. You mentioned Houston before, Pittsburgh, Salt Lake City, St. Louis.
Yeah.
What do you think? And you also mentioned that these tier one markets are sort of through their status as established big life science markets, they will be more resilient. So I was thinking, what separates like a real long-term cluster from a market that just has one or two headline projects, so to speak?
Yeah, great question. One thing you'll notice if you look across the geographies that you described, there is always, coming back to the academic research, there's always a meaningful institution in that market.
Yeah.
This is my observation. Others may view it a little bit differently. I think there are a handful of factors that play into the emerging markets. One is availability of space. They tend to be less well supplied with space. So the good news in today's market is they're not sitting with an oversupply of space. They're about right and perhaps can accommodate requirements. The other thing that I find interesting and that I've observed here in the Philadelphia market and I've observed in other markets is that if there's a very particular area, if you will, of expertise, a center of excellence, whether it's gene and cell therapy, whether it's radiotherapy, whether it's CAR-T or CRISPR or whatever, companies that are working in that space may want to locate in proximity to a cluster where there's a robust community of science in the area of interest for them. And, the other thing that I find fascinating is that there's often collaboration through multiple institutions on an area of discovery. So that you may find that there's a scientist who's working on this across three markets. There are three scientists across three markets that are involved in the creation of a therapeutic and a company behind it. And then to some extent, it becomes a jump ball as to the various factors that I described before. Where's the talent? What's the cost to operate in that market? What are the benefits to operate in that market? So you'll see some of those dynamics at play as well. But I do think it's going to be interesting to watch the science that's coming out of each of these emerging markets and what the opportunity is, and also the extent to which the institutions are actively supporting and contributing to the generation of new therapeutics. So that would be how I would address that. And then I will add the ability and desire of the state to support that as an area of growth, either within a specific city or statewide across the state.
Well, thank you so much for that breakdown. And I wanted to sort of to close things off here and sort of zoom back out. Just a very broad question here, like where do you see the life science sector headed in 2026 and beyond?
I think we will see recovery. I think we'll see, as we talked about a little bit earlier, I think we'll see some trading of buildings, probably qualitatively on the lower end of the continuum, or in the hands of either developers or investors or lenders who just feel overly exposed to this market right now and who feel like they just need to do some balancing to be better positioned. And as we discussed, that's potentially opportunity both for acquirers of these specialized buildings, and that also will translate to opportunity for the users of those buildings
Yeah.
to the extent that the price point comes down as a result.
Yeah, and those opportunities that you talk about are mostly adaptive reuse or something else, maybe.
I think you're going to see a handful of things. I think you're going to see a little bit of that reversion I mentioned. I think you're going to see some trading where landlords are in a position to be very attractive relative to the broader market because of a transaction, and as a result, maybe the most attractive opportunity for the users. And so that then it could stay in the life sciences vertical, very much could stay in that, and just could have more success than their competitors because the price point is lower, perhaps the opportunity to contribute dollars because it was bought well and it's well funded. They could contribute dollars to prospective tenants build out. So there are a variety of factors that I think will play out in that regard. And I do think there will be some reversion back to office use, maybe to innovation uses that are not as intensive as life sciences.
Okay.
But I think that if I were in the developer's chair, I'd rather move from life sciences to innovation than to pure office. But obviously, at the end of the day, the bottom line is what rent can I command, and how can I take care of my investors overall in the situation. So
Cool. So there is some optimism there. Great.
I'm encouraged by what we're seeing. Yes.
Great. Well, Joe, thank you so much for this very insightful conversation. I feel like I learned a lot today about life sciences. And thanks for taking the time.
Peter, it's been a pleasure. I've enjoyed talking with you.
Thank you so much.